Welcome everyone back to Maverick Trading's educational class series, and Corey Halliday here with you today. Today's class is titled Options Gone Wild, and this was an idea that came in from Darren, who suggested that we talk about different circumstances where maybe the options market is a little weird, a little wacky, and what that means. And I've seen many different things in the options market that have an explanation for them, but they look strange on the surface. So let's talk about a few of those ideas today. The first one we're going to start with is non-standardized options. What is a non-standard option? Well, when you pull up an option chain, first thing you kind of expect to see is a normal strike price. And notice these wacky strike prices. Like, who would have ever come up with 107.60, 112.60, 117.60 for a strike price? Usually a strike price would kind of go in an orderly fashion. It might be 105, 107.50, 110, and so on. So you'll see a little wackiness that way. These could also be different. Like this particular stock is VMware. Now, in businesses go through mergers and acquisitions and spin-offs and so on. And VMware is an example of a spin-off. So a spin-off can mess up the options a little bit. And so then there becomes standard options and non-standard options. So VMware used to be part of Dell. Dell was this big corporation, and VMware was a part of that. And Dell decided, you know what, we're going to become two different companies. We're not going to be under the same Dell umbrella. Dell is going to go off on its own and continue to sell Dell computers and so on. And we're going to make VMware trade on its own, that sort of idea. And so this can happen where basically the companies will break apart and become two different stocks and two different companies and so on. And there were some tax purposes for that. Dell had acquired EMC years ago. Again, that's a merger acquisition. It acquired EMC, which owned VMware. Dell then owned VMware and so on. And so they broke apart. Now they're two separate companies altogether. Dell trades under its symbol, VMware. But since they used to all trade under Dell, it kind of can mess up the options. And sometimes in these circumstances, you'll look at an option and it'll have a wacky strike price. It'll have weird pricing that looks really weird and so on. And the only way to actually know what it entails, that it's a non-standardized option, is through kind of looking at the details. And they'll usually have, if it were a non-standardized option, they'll have some sort of marker on it so it stands out. Hey, this is basically telling you this is a non-standardized option. It would highlight it and so forth. And then if you wanted to dig further, you can actually call 188 Options. This is a true story. This is the Options Industry Council. And if you call 1-888 Options, you basically can talk to them. They'll ask if you're a broker or if you're an individual and so on. And then you can say, hey, I'm seeing some weird strike prices. I'm looking at the January 2024 strike calls in VMware. Can you tell me, is that 100 shares or what does it entail and so on? And they'll give you the details. They'll give you the breakdown. And it might be a circumstance where they say, okay, well, VMware was spun off from Dell, so some of the options are standard. Like this one would be a standard option. That 105 strike, one contract controls 100 shares of VMware stock. That's a normal standardized option. That's exactly what we would expect. That's what 99% of all options do. But this one, he might say, that one's a little wacky. What it is it's, 60 shares of Dell, and it's 40 shares of VMware or something like that. And it might even have some cash and $12, and I'm just making stuff up, 36 cents in cash. And that's what that contract is. So if you trade one contract of it, let me write it out this way. One contract of that non-standardized option might have all this wackiness in there. And so to kind of figure out if you wanted to trade that, you'd have to say, well, do I want to trade 60 shares of this, 40 shares of that, and some cash and so on? Because that's what it's going to settle for. That's what it actually controls and would be the settlement value. So there's pre There were already some options that were out in the market and were trading before the spinoff happened. Those options don't just go away. They don't go to zero or anything. They become some calculation of whatever the spinoff was. Now they control the pre-spinoff value, whereas the newer contracts control the norm. They'll just, every contract that's newly created for VMware will track 100 shares, but the contracts that existed before that can be non-standardized and can have some wacky calculation to them. So if you run into a non-standard option, what do most people do? They say, that looks really strange. I'm going to move on and trade a standard option. Where this gets more tricky is when you're already in a position and then it becomes a non-standard option. And that's normally what would happen to me is, for example, I own some of this. This is why I remember the Dell VMware situation, is because I actually had stock and option positions and so on. So when they went through the spinoff, it changed some of the dynamics of those options. So that's the first kind of options that have gone wild and wacky, non-standardized options. That means they do not control 100 shares of the stock like the vast majority of options do. They would control some, portion, some of this, some of that, maybe even some cash involved and so on. And if you wanted to see what its value was and so on, you'd have to say, well, what is 60 shares of this plus 40 shares of that plus this cash? How much is that worth? And that's how those options would trade. The next thing, dividend risk. When you're trading options, there is dividend risk involved. And I wanted to pull up an example that would be pretty typical to where there's risk to you as an option trader. So look at this option. Here's AIG. It's trading at 52.34. It has some September 16th options. That's the expiration date for those options. And then over here, I can see that it goes ex-dividend on September 15th. Now, normally you'll start getting notifications from your broker. Hey, this stock is going to go ex-dividend. Be aware of this, and so on. This is the circumstance where it could cost you a little bit of money if you don't do something. Now, the vast majority of the time, you can ignore dividends. If you are trading the puts, you can ignore dividends. If you are trading out of the money calls that are still out of the money, you can ignore dividends. If you're trading at the money calls and they're still at the money, you can ignore dividends. But if you are trading calls that are in the money, meaning the strike price is past the stock price, this is where you've got to pay attention. This is where it matters. So if you're trading puts, doesn't matter. Out of the money calls won't be exercised early. At the money calls won't be exercised early. But in the money calls could and probably should be exercised early. And so we have a class on this, dividends and options and how this is involved. But look at it this way. This 50 strike call, these 45 strike calls, this 40 strike call, and this 30 strike call. These are your in the money options, and notice that they're shaded in. So if we were trading any of these up here, we wouldn't need to worry, right? But these ones we do, the 30, the 40, the 45, the 50, those are the ones that could and maybe should be exercised early, especially when ex-dividend date is very, very close to expiration date. If I own, let's just say hypothetically, I own this 40 strike call. Well, if I own that 40 strike call, I have the right to buy the stock at 40, and it's worth more than that. It's worth 52.34. So my call is in the money. Now, I don't have a lot of risk if I exercise that 40 strike call a day early. If I exercise it before September 15th, let's say on September 14th, I notify my broker to exercise that call early. What I've done is turned my option into the stock a day or two before its expiration. Well, that's no more risky than continuing to hold that call into expiration. Because I would say, well, the stock's not going to go from 52 below 40 in the next 2 days in all likelihood. It might go down, it might go sideways, it might go up, but I have just as much risk in the 40 strike call as I do owning the stock. I'm just going to lose or gain intrinsic value. If the stock ticks up, I'm going to make a little bit more owning that call or the stock. And if the stock ticks down, I'm going to lose a little bit owning the call or the stock. It's the same thing. Owning the 40 strike call 1 or 2 days before expiration is basically equivalent to owning the stock. There's no, unless you think the stock can go below 40, they're basically the same risk, same reward. But here's the thing. Owning the stock, I'd get paid the dividend. I'd get paid 1/4 of $1.28. That's how much it's paying out annually. So if I own the stock, I'm going to get that payment of 32 cents. 32 cents per share. If I continue to hold the 40 strike call, I'm not going to get that payment. I'm going to miss out on it, right? Call owners don't get it. Now, here's the other thing. On the ex-dividend date, they're going to adjust the stock price down by the dividend amount. So if the stock should be worth 52.34, it's going to open tomorrow at 52.02. Basically, it's going to open tomorrow with its stock price adjusted down the amount of the dividend. So if I own the stock, my stock is adjusted down 32 cents, but I get paid the dividend. So plus 32 minus 32, no gain, no loss. I'm just no worse for the wear. If I don't exercise this 40 strike call early, I miss out on the dividend, so I don't get paid that, but my stock is still adjusted down by 32 cents. So basically my 40 strike call lost 32 cents without an offset. And this right here is the number one reason that options get exercised early. 99% of the time, if an option exercises early, it's due to the dividend. It's because somebody is in the money on the calls and they're sitting there going, well, I might as well exercise it a day or two early and get that dividend rather than just sit here holding these call options. If I own the calls and I do nothing with my position, I'm going to lose 32 cents overnight. If I exercise it early, I don't gain, I don't lose, but I at least offset that dividend risk. I'm just no worse for the wear, right? I end up 0 instead of minus 32. Now, someone might say, well, why don't they just sell their call? They might, but somebody is left owning that call, right? Somebody out there owns it. And so to them, they have to go through this process of early exercise. This is why 99% of the time it doesn't make sense to exercise early. The only circumstance where it really makes sense to exercise early is when the call is deep in the money, the ex-dividend date is very close to expiration. If this ex-dividend date was September 15th, but the option expiration was November, would they exercise early? Heck no. And it wouldn't make sense to, because you'd have tons of time value. And if you exercise a November call early, you're wasting a couple of months of time value. That's not a good trade-off. You'd be wasting a couple of dollars to get the 32-cent offset. No, no, no. Not a good idea. But if you're in September 16th and it's a September 15th ex-dividend date, there's no time value left in that option anyway. So you're not wasting time value exercising it a day or two early. I get that that's kind of an advanced concept, but that right there is a risk. So what do you do? Well, if you're trading the puts, don't worry about it. If your calls are out of the money or at the money, don't worry about it. If you have any calls that are in the money, you better be aware, you better look at your portfolio, and any time you have a long call or a short call that's in the money, you better be aware of whether it pays a dividend and when that ex-dividend date is. That's your job as a trader. And the easy approach is to close the calls before the ex-dividend date. That's the simplest approach. The less simple approach is to figure out whether you should exercise or whether it's going to be exercised against you and so on, and then going from there. Let's say that you wake up one morning and an option has been exercised early against you. It's probably due to the dividend, which we just talked about. But what do you do in that circumstance? Now, we've received emails or, frantic calls. Hey, this call was exercised early. What do I do? Well, first of all, the only exercise that would happen against you would be a short call, right? If you own the call, if you're long the call, it won't get exercised early unless you yourself do it. So it is always a short call position that gets exercised early. Could be a short put, but that would be kind of rare. And in any of these cases, if an option is exercised early, you really are in the same risk to reward you were in before. So let's just give you an example of a trade. Let's say that you shorted the 100 strike call, and you're long the 105 call. This is called a bear call spread, right? Bear call credit spread. When you put this trade on, you collected a credit. Let's say it's $2 or whatever. So you got paid a $2 credit. Since it's a $5 spread, you could lose 5 minus your 2 credit, so you have risk of $3 in this trade. That is your reward to risk ratio in this trade. $2 of reward for $3 of risk. Now let's talk about the early exercise. You could wake up one morning and realize that this call no longer exists. And you open up your portfolio and you are now short stock and long the 105 call. You still own your call, but the short call got exercised early. So you're still long the 105, but you got short the stock at 100. It was exercised. Somebody said, I want to take the stock. So this call no longer exists. It's gone. It hit its expiration early. It got exercised early. Being short the stock at 100 and then owning a 105 call still leaves you $5 of risk. You might have a couple of days until expiration, but your trade did not change. You are still at risk 3 and reward of 2. In fact, an odd thing has happened there where your reward has actually improved, possibly. Because now you're short the stock at 100 and you're long the 105 call. Theoretically, if the stock were to tank, your call would expire, but your short stock would make infinite amounts of money. So if hypothetically the stock were to tank to 90, 80, 70, you'd actually make a killing in this trade. They actually improved your possibility of making money. Now, the only way that they would do that is because they're pretty darn sure it's not going to go back below 100. Stock's probably trading at 110 if they're exercising that early. But the point is that you're still in this risk to reward. You don't actually need to do anything with this trade until expiration. You'll still end up at this risk and reward situation. What might have happened to you though, is it might have a dividend involved, and you, because you're short the stock, you might have to pay that. And let's say it's a 32-cent dividend. Because you weren't paying attention to the dividend, you might actually have lost 32 cents or whatever the dividend amount was. So your risk goes up to 332 and your reward potential goes down to 168. You just lost 32 extra cents. Why? Because if you're short the stock through an ex-dividend, you have to pay the dividend. And if it's a 32-cent dividend, you have to pay that out. So your risk to reward actually worked against you. You need to pay attention to dividends when you're in the money calls, right? You need to pay attention and get out before the ex-dividend date. So it is true that This early exercise might have cost you the dividend amount and made your trade worse by the dividend amount, but it didn't change it any more than that. Here's where people freak out. They're like, oh, I'm short the stock. Uh-oh. And they close this position out, leaving them just long the 105 call. And now they've really changed their risk to reward. Now, if the stock goes crazy, they might make a lot owning this call, or they might lose a ton. Because if they close the short stock position, they basically have removed this risk to reward and gone to an infinite risk and reward. Like if the stock goes bonkers to the upside, this was a protected position. It was protecting the short stock. If you close your short stock position in a panic, this just becomes a long call, which has huge risk and huge reward. If the stock goes up a ton, now you're just making money, dollars and dollars. But if the stock goes down, you're losing dollars and dollars. So all of a sudden, and don't do this, don't panic. If an option gets exercised early, you're still in the same risk to reward roughly that you started with. But if you in a panic close one half of the trade and not the other, now your risk to reward is going to go bonkers. Now you could make, I don't know, 10 bucks, 20 bucks, 30 bucks, but you could lose 10 bucks, 20 bucks, 30 bucks. It becomes, a big old risk to reward. So if you're in a spread trade and one part of it, if you're in a butterfly, if you're in a condor, and the short calls, again, it's going to be the short calls that exercise early. First of all, you probably weren't paying attention to the dividend. I'm guessing that's why it would exercise early 99% of the time. And second, if that does happen to you, don't, in a panic, close out part of the trade. If you're in some butterfly and the short options exercise early and then you hurry and close that short stock position, you now own those two long calls in the wings. You've got a crazy big risk to reward. So you don't make good decisions because you panic better than everyone else. That's not how this works. Don't do things in a panic. Don't do things in a rush. Just really take a step back and say, okay, what do I have on? What's my risk? What's my reward? What's my probability from here? Maybe go put it into a risk graph, right? Go say, well, if I'm short stock at 100 and I still own the 105 call, where am I at? What's my risk? What's my reward? Oh, I collected this $2 credit. I still have $5 at risk. Okay, I'm still roughly in the same risk and reward that I originally was. Hope you've enjoyed this class on options gone wild. It's always a fun thing to just kind of explore the markets and talk about different scenarios and potential opportunities and things you might run into so that you'll be aware of them and understand what's happening throughout that process. Have a great rest of your day, and we will see you next time. Goodbye, everyone.